Good evening, everyone. My name is Rosalind Brown of Your Wealth Guidance. And as you know, on Mondays, we come to you with actionable insights to help you on your financial independence journey. We have another great speaker here, and I know we've had a few topics that go along with real estate and getting into it, whether it's house hacking, whether it's flipping properties, and so forth. But here is another way to passively enter into the real estate market. So we have Colette Fitzgerald. She has been a real estate broker in Austin, Texas for the past 17 years. After several years with two different local brokerages, in 2016, she opened her own. It's called Best Life Real Estate because home is where your best life begins. She has also been a real estate investor since 2003, starting off with single family rentals, and has recently begun investing in commercial real estate through syndication and funds. She and her husband, Edgar, have been on their fire journey together for 13 years and plan to retire next year at ages 48 and 54. They'll take 1 year sabbatical to travel the world. We all love that. And Colette also cares deeply about empowering women and girls and serves on the board of directors for a Texas nonprofit called Girls Empowerment Network. Her strong belief is that there will be no true equality until everyone has financial equality. She is committed to doing all that she can to help make that a reality. So without further ado, I want to thank you so much for joining us, Colette.
Thank you, Rosalind. I appreciate it. Thank you for asking me to join. I told you when you asked me, I told you I'm not an expert. I do have a lot of experience and I want to share all that experience with your group. So thank you so much for having me. And also, obviously, I'm not a person of color. I am married to one. He's actually an immigrant from Guatemala, which I know is one of your favorite countries. But I do feel very strongly, like it said in the bio, that I'm such a proponent of women empowering themselves because we aren't going to have equality until we have financial equality. And, I have a client who's a detective here in Austin, and he told me, women stay in abusive relationships because why? Finances, financial reasons. He works a lot in domestic violence. And, you think about all the different ways that you're just disempowered when you are not financially secure yourself. So I feel like in order to have that equality, we have to empower ourselves, and that includes financially. I told you, like when I got married 10 years ago, a lot of people asked me if I was going to keep working. And I was like, why is everyone asking me that? And then I asked my husband one day, I'm like, has anyone asked you if you're going to stop working when we get married? And he's like, nobody has asked me that. I'm like, why are people asking women that question? And I know a lot of women choose to stay home or have babies and raise the children. I get that. That's totally cool. But just to assume, that a woman would not want to have her own career and her own income, it tells you we still have a long ways to go. So, but anyways, all that being said, thank you for having me, and I'm really excited to get into it.
Thank you so much for being here. And I love the story. And definitely, I love Guatemala. So, I'll be back there soon too.
Yes. Awesome. So I do have a lot I want to share about commercial real estate, as you mentioned. And then once we're done with that, I want to get into just some financial lessons I've learned along the way. It's been quite a journey, couple decades, kind of coming up on 3 decades now. So it's like, you say this is reaching financial independence, financial freedom is not something that happens overnight. It takes time. And I'm just a regular person. I didn't have any inheritance. I didn't have a dad who knew anything about real estate investing. I just learned all of this on my own. And, when I got married, my husband and I had been on our own journeys. I always say it's like we were like the Brady Bunch, but instead of kids, we were like houses. Because he had 2 houses and I had 2 houses. So we got married, we have 4. And then we've added on to that since then. And so right now we are about 1/3 of our overall portfolio is in stocks. A third is in residential real estate, like houses, and then a third in commercial real estate. So I do have experience in it. Like I said, I'm definitely not, a guru financial expert. I'm just going to share my experience in the commercial real estate part. And then we can talk about just general financial lessons I've learned on this journey. So let me see. I'm going to go ahead and share my screen if I can. Let me try this.
Yep, we should be good to go.
All right. Can you see this?
Yep, we see it.
Awesome. Okay, so we're going to talk about commercial real estate investing basics. I am a real estate broker, like you said, but I want to point out I am a residential real estate broker. So I don't actually sell or help people buy commercial real estate. Personally, I am a commercial real estate investor. So just to make that clear. So what is the difference between residential and commercial real estate? So you're all probably familiar with residential real estate. It's going to be your single family homes, which can also be, condos, townhomes. And then it includes small multifamily, duplexes, triplexes, and fourplexes. So that is all considered under the umbrella of residential real estate. If you're going to invest in residential real estate, you can get a loan personally for any of these under the residential umbrella. If that makes sense. Okay. Now, commercial real estate, we are talking about multifamily apartment complexes. So anything over 4, which can all, go up to 500 maybe is the largest one I've ever seen. Office and medical buildings. So remember that place we used to go, the office building? That place we used to. So
we're not going back.
We may not ever go back. Might not be a good investment. But there's still some that are out there. And of course, like medical buildings, like where you go to your doctor's office, that's commercial real estate. Of course, hotels, retail shopping center. So this could be your shopping mall, or it could be your strip center with your grocery store and your Home Depot. Mobile home parks are commercial real estate. So this is not the mobile home itself, but many times they are on a piece of land, which is called a mobile home park. So you can invest in that, which is a pretty expensive piece of land usually. And then self-storage, being Americans, we're always going to have too much stuff. So self-storage is a good investment. And then industrial is also commercial real estate. So, you see those big Amazon warehouses, that's industrial commercial real estate. And then lastly, mixed use or special purpose. So this will be like your movie theaters, your bowling alleys, your hospitals, things like that. So basically, when you just go out and about living your life, you're pretty much surrounded by commercial real estate at all times. Like I was telling you, Rosalind, when I was younger, I would never have imagined that I would see a beautiful hotel and think, oh, I can own part of that someday, or I'm going to invest in that someday. I never even knew that was a possibility. But it is a possibility for all of us, really. So how can I invest in commercial real estate? So there's really 2 main ways. The first is active, where you buy and manage the asset. And I've never actually done this. So I'm just putting that out there because I just didn't see the point, to be honest. I mean, if you have the ability to get a loan for $20 million and you want to buy an apartment complex on your own, more power to you. But for me, that was really not what I wanted to do. And I think for most of your audience, it's probably not the path they want to take. But if you do, that's an option. And then the second one, of course, is passive investing. So when you decide to do this, you're investing a specific amount of money along with other investors. So we call this crowdfunding. And then you receive a return on your investment through regular cash flow and shared profits when the asset is sold. So when you're investing passively, it sounds, it is what it sounds like, that you're not actually doing anything, but you are part owner of the asset. So you're not just lending the money, you are part owner in that asset. So when it gets sold, you get to share in the profits. We'll get more into that in a minute. So how can I invest passively in commercial real estate? So since passive is definitely the route we want to go down here, so there's basically 3 ways. And I know there's a lot on the screen, so I'm going to go into each one. So the first one is to invest in an individual real estate syndication. So you'll hear this word syndication, and it basically just means a crowd-funded real estate investment opportunity. And it's a partnership really between a sponsor and multiple passive investors. So a sponsor is a company that actually does this for their business purpose. So they are buying apartment complexes, for example, and they have their, a business plan that they're going to buy that. Maybe it's a little bit run down apartment complex, and they're going to go in and fix it up, rent it with, higher rents, kind of restabilize it, and then sell it. That's a pretty typical business plan you'll see. So the sponsor is actually the company or the people doing that. It can be 2 or 3 people, or it could be a company of 100 people or more. I mean, there's way larger ones too. So that's what the sponsor is. And then you would be one of the multiple passive investors. So in a syndication, it can be a development or a value add deal. So development is if it's a total ground up to be built development. So the company bought a piece of land and they're going to build a hotel on it, it's a development. If they bought an old rundown hotel and they're going to fix it up, it's a value add deal. It already exists, they're just going to add value to it one way or another. And then it's one type of property in one location. So we're talking, one apartment complex in Dallas, Texas, for example. It's not going to be multiple properties, it's going to be one. And again, you are part owner. Okay, so that's a real estate syndication. The second way you can invest passively is in an equity fund. So this is a fund that holds multiple properties. It may include both development and value add deals. So maybe they already have some apartment complexes they're just fixing up, and they've also got a plan to build a brand new one as well. But it's all within this equity fund. It may be geographically diverse. So it could be, it's usually something like 10 to 20 properties. And like the one that we're invested in has properties all throughout the South and like Southeast pretty much. So that's kind of an advantage of doing a fund, is that you get that geographic diversity. You also get the type of property diversity. So it may include, an Amazon warehouse and apartment complex and a hotel and a medical building, so if you have one asset class, one type of property like offices that suddenly goes down in value, you're not in trouble. You haven't put all your money into that one thing. You've got it kind of diversified across different types of commercial real estate. And again, on that option, you are a part owner in the property. The third option is called a debt fund. So I've included this because it's a great way to earn passive income, but you don't actually own the property. In this case, it's kind of like you are the bank. So you, along with thousands of your co-investors, pull all your money together, and then the debt fund managers will manage that money, and they'll lend money out to individuals who are buying and selling properties. So you yourself are not any part owner, but you are the bank. You're lending the money and you are receiving a return. And it also might be geographically diverse, so it can be spread out all over the United States.
Now, Colette, there's a question about for the debt fund. would that be more risk than the others if they don't either pay back or any of those items?
So I find it to be actually less risk. And well, I'll tell you the one that we're in, and I have a list of all the resources at the end, but we're in one called DLP Capital. DLP stands for Dream, Live, Prosper. And we are making about a 10% return, and they pay it monthly. Literally, the money just goes into our bank account every month. And the reason I feel like it's actually a little bit lower risk is because it is spread out among hundreds, if not thousands of loans. So they're giving out money to people doing all these projects, they're building new houses, or they're fixing up houses, also some small commercial. So they'll buy a small apartment complex and fix it up. It is spread out among so many people and among so many projects. Even if one project falls through, or they don't make a profit, or they stop paying the payments on the loan, there's so many other ones that it's barely going to make a dent. I mean, you would have to have a large majority of the people stop paying, and then maybe you would start to make lower returns. So I don't know, just from my point of view, I feel like it's a little bit less risky. But the other ones, I'm not going to say they're not risky, but they have a hard asset backing them up. So it's not just a paper asset, like a stock, there's an actual building there. So even if it's somehow mismanaged or somehow doesn't make much of a profit, I mean, it's not going to ever go down to zero, because it's an actual hard asset, which is the beautiful thing about real estate. That makes sense.
Somebody who says they want to do both the active and passive investing. So at least these are some options, either or, which you're doing both.
We do all three of these. Yeah, we do all three. We have some real individual syndications we invested in, some equity funds, and then awesome debt funds. So yeah, do them all. I mean, that's diversify. In case one starts to not perform, you still got two more, but they will perform. And, if they've made it through COVID, I mean, we've invested in all three of these, all throughout COVID. And I just feel like that just gave me even more confidence that this is the asset class that I want to be involved with. So just throwing that out there. Everybody has to make their own decision, but that's been my experience. All right, should we go on?
Yep, we can move on.
Okie dokie. So since we love apartment buildings, particularly multifamily, we're going to talk. Oh, sorry, I jumped ahead. So first of all, how do I get paid as a passive real estate investor, and what kind of returns can I expect? Okay, this is the good part, right? The money. So going back to the funds, so starting with equity funds. So your typical annual returns will be between about 10 and 15%. You're typically paid monthly or quarterly distributions, and it's a mix of cash flow and appreciation. So think of an equity fund almost like a house that you're renting out. Yes, you're going to make that monthly cash flow from the rent, but you're also hoping that the value of that home is appreciating, right? So you're growing your wealth through the appreciation. It's not all just in cash flow coming to you every month. It's a good bit of both, hopefully, is what we're going for here. There are some tax advantages to it, which I'm not going to go into all that because it's a lot, but essentially there's depreciation similar to how you would do on a single family home. And the goal oftentimes of equity fund managers is to really reduce your taxable income as much as possible. Doesn't mean you're not receiving the money, it's just not showing up on paper because they've done so much depreciation. So then as an example, I just put, if you invested $100,000 into an investment like this, you could expect about, I think I put this on a 12% annual return. So about $500 a month cash flow, and then $500 a month appreciation. So you get that $500 a month. The appreciation, you realize it when you sell your portion. So if we were to say, okay, we want to get out of this fund 5 years from now, our 100,000 that we put in is going to be worth a lot more 5 years from now because of all this appreciation that's been going on. So I don't know how much it's going to be in 5 years, but let's just say it's going to be worth 150,000 at that point. So we get our 100,000 back plus the profit, 50,000. So that's kind of how the equity fund works. The debt fund, again, you're not owner on this. You just give the money and you're getting that payment every month or quarter. So typical annual returns will be a little bit lower because, again, it's not as much risk typically. So it's 7 to 10% is what you can expect. Also paid monthly or quarterly. And again, it's all cash flow, so there's no appreciation there. So in 5 years from now, when we want to get our $100,000 back, that's all we're getting back is 100,000. We're not getting 150 back like we could get on an equity fund. And there's no tax advantages. So it's taxed as ordinary income. So there's no depreciation, all that, because again, you're not owner. You're just receiving money. Interest essentially from your investment. So I put another $100,000 investment example at 10%. That would be about $800 a month in cash flow, which is pretty awesome.
Now, are there minimums? So we talked about the 100,000, but if you had 5,000, is that still enough to get started?
Yes, that is coming up. So the one that I know that has the lowest minimum, it's $10 is the minimum, and that's Fundrise. And I'll show you that.
We got that.
But there are other ones that'll have like a $10,000 minimum, 10 to 50,000. But it's like I was telling you, it's kind of like putting a down payment on a house. It's kind of in that range. So a lot of people are saving up money for a house, and I do think you should buy a house. I know there's some people who are in the rent camp, some people are in the buy camp. I think as a realtor, I'm just always going to be in the buy camp because I just know what a great investment real estate is. But this is another way to invest in real estate. This is still real estate. So yes, it's kind of in that range, but yeah, you can go as low as $10. All right. So next, this gets a little bit complex too. So I'm going to try to break it down for y'all. So on the individual syndications, okay, so this is when it's like one apartment complex. So this one that I put an example, it's apartment that we invested in the Dallas-Fort Worth area. And you can see it was like almost $112 million. So it was pretty expensive. So I'm going to just talk about this capital stack for a minute. So the way that you are paid your returns on an individual syndication, it can depend on a few things. One thing is if it's a development deal, meaning it is going to be built, you're probably not going to receive monthly cash flow. I mean, you're for sure not going to receive monthly cash flow until it's built and in use. So once it starts getting renters in there and they start paying rent, you start making your cash flow. But if it's something that's already built and already in use, then you're going to start making that cash flow. I put on here once cash flow is available. So you just have to look into each deal and find out when is that going to be paid, when it's going to start being paid. And then how much you get paid depends on, again, several factors, but it depends mostly on your position in the capital stack. And that's what I have here. And this is, I don't know if anyone's ever heard that word capital stack, but this is something I had no idea. I had to learn all about this. So again, I'm just sharing what I have learned and I hope it all makes sense. But in this example, you can see at the bottom where it has the total amount. So what that is referring to is how much the property cost. So this is how much the sponsor, remember the sponsor is the company actually buying it. That's how much money they needed to buy the property. So at the very bottom, you see senior debt. So 67.7% of the purchase, which was over $75 million, they got through senior debt, which is a bank. So that's like your big old institutional lenders. They don't make a lot on their money. It's about 4%. It's kind of like a mortgage, interest rate. So that's how much the bank will make on their loan. Next up, the priority is preferred equity. So preferred equity it's another step in the capital stack that can be filled by individual investors, or it can also be filled by those funds. Remember, like those equity funds, a lot of times those will come in here and they'll provide that preferred equity. And you typically, they consider it a safer position because on the capital stack, the ones at the bottom get paid back first. So let's say 3 to 5 years from now, when the property gets sold, that senior debt is going to get paid. Trust me, that bank is going to get paid. Then after that, all the preferred equity investors get paid. Oftentimes it's a lower return because it is safer, right? So we always talk about like the higher the risk, the higher the reward. So in this preferred equity position, you're a little bit safer because you're getting paid back sooner and fully before anyone else or before the next ones up the stack. And you may participate a little bit in the profit, but it may be a smaller percentage of the profit you get when the property is sold. So it's typically a fixed amount, somewhere between 7 and 9% annually. So then comes at the top part, like the orange part where it says investor equity and sponsor equity. So that is something that we call that common equity. So the common equity position is at the top of the capital stack, and it is considered the riskiest position because, again, all the people at the bottom are getting paid first when the property sells, but you have the opportunity to earn a higher return because you share typically 70% of the profits go to the common equity participants. So so you're still receiving a cash flow on a monthly basis. But when the property sells is when you make your big money. And so the 13 to 28% annual return is not necessarily going to be paid to you every year. It's just that when the property sells and you make your 100% profit, if you were to work that out over the past 5 years, it would end up being somewhere in that range, 13 to 28%. That's a lot of information. Does this all make sense?
I think it's making a lot of sense to me, and it's good to see kind of what order. And, we know the bank has to make their money, and I guess you go to the bank first. And this kind of makes sense when you think about if you're a real estate investor, typically you're not getting the full 100% financing. You're not getting 90% financing. So this kind of looks like about 67, 70% financing, and they got to come up with the rest.
Exactly.
So then kind of where you stand, and as they're coming up with kind of that extra line of credit or that second mortgage is probably what we know more of it to look like, then they have to pay more.
Exactly.
The safest is kind of that first lien position. And then on top of that are going to be kind of the higher rates that they're going to have to pay to get closer to that 100%.
Yes, and being an investor in that top common equity position, you are a limited partner with that sponsor. So, and often in the preferred equity position, you are as well. You're not a lender, you are a limited partner, which is also kind of known as like a silent partner. You're getting some money to get the deal done, but you're not making any decisions. You're not involved in the day-to-day management. You don't get to decide when they're going to sell, for example, or when they're going to keep it a few years longer. So you are a partner, and you do participate in the profits when it's sold, but you are a silent partner. And there's a lot, I'm going to get to this in a minute, but there's a lot of these crowdfunding websites that are, like CrowdStreet is the number one that we use. But what they do is they have these sponsors come and do like a whole webinar, and they talk about the project and everything, and they tell you, we've already got our senior debt secured, we've got our preferred equity secured with a private lender, so now we're looking to raise $22 million so that we can go ahead and move forward with the project. And so then you've got these thousands of investors like us listening to this webinar, and we're like, I like that project, it's in my city, or it's in a place I've been wanting to invest, and I'm going to invest 25,000 in this one, you know, and then the next person does the same, and then the same, and then eventually they've got their 22 million. And it could be, like I said, it could be 100 people, it could be 500 people. Some people may be doing 10,000, some people might be doing $1 million. You know, it ranges all over the place. But there's, you know, crowdfunding websites that you can go to and just look at the deals they have, and just kind of start to research, you know, and understand. You're going to see this capital stack all over the place, and you're going to see the preferred equity rate of return. The IRR that I have on there, it stands for internal rate of return. So you might have seen like ROI, like return on investment. It's a little bit different in commercial real estate. They call it IRR, internal rate of return, which basically means by the end of the project, however many years it takes, it will be, it's like the time of money, the time value of money, something like where eventually you will have earned 28% or whatever the amount is by the end of the project. It's not necessarily that you receive it each year. Does that make sense?
Now, in terms of a time commitment, is there like a lockup time in terms of 1 year, 5 years, 20 years? What does that look like?
Yes. Okay, let's get to that. This is coming up. Perfect segue. So here are things to consider. So as we've talked about, the minimum investment, 10 to 50,000 on most of them, but Fundrise is $10. So that one's an awesome option. There's also the time frame. So it is usually a long investment time frame, 3 to 10 years. And 5 years is the most common. That's what I think most of ours are 5 year. So if it's a development, it takes time to build a huge hotel or a huge apartment complex. And then from there, like I said, they want to get it ramped up, get it rented, get it in, you know, in use. And then they'll see, is it a good time to sell? Should we sell now? Should we hold it? You have no decision-making power on that. So you shouldn't do this unless you're okay with the money being there for that long. So number 3, you may earn monthly or quarterly cash flow. It might not start right away, and it may fluctuate. Like I said, with the development deal, you're not going to get anything for at least a year. If it's already in use, the cash flow it may have been a poorly managed apartment complex, for example, and they may have just had low rents, people not paying rent. They might have been in total disrepair. So there may not be a ton of cash flow right at the beginning, but once the sponsor gets in and starts making, you know, all the renovations and gets, you know, tenants start paying again, or they get new tenants at higher rentals, then you're going to start seeing your cash flow. So I just want to point that out so you don't think, okay, I put my money and next month I'm going to get my first check. Debt funds, that's true. That is true on debt funds, but on any type of, when you're owning the asset, it's going to take a little bit longer and it could fluctuate. So keep that in mind. So yeah, 4, we kind of already talked about, it's not a liquid investment. So if you think you might need the money back during the next 3 to 5 years, don't invest it in commercial real estate. It's a long game, but that's how you grow wealth, you know?
Now, from my knowledge, and you correct me if I'm wrong, of course, you know, you're locking up your money for X number of years, but I guess there is a way to get your money back, maybe with a significant hit to the principal. Is that correct?
Some you may be able to. That's something to research before you invest with that particular sponsor. Just ask them like, well, what would happen if I need to get my money back? funds, whether they're debt funds or equity funds, it's a lot easier to get your money back because they've got lots of deals going on and they've got lots of people coming in and out of the fund. So, but when it's like one deal, they need your money, for the whole time period. So if you think you might need it back, a fund would be your best option, I think. And check on it before you invest and ask them that question.
That's good to know. But for the questions you should ask, I know the first time you do any type of investment, you might not know what to ask. So these are some good things in terms of the things to consider to kind of write down. What's the minimum? What's the time commitment? Those kind of things.
Definitely. Yes. The time. And if you go on CrowdStreet, this is all for every deal you look at, and anyone can get into CrowdStreet. You have to like sign up to get their access to their deals. But once you're in, you just click on it and you'll see all their deals, and it'll tell you how many years their target time frame is and what's their target return, and all that kind of stuff. But then you still need to ask them just to make sure you have all the answers you need. So number 5 on things to consider, I think I've said it a few times, you don't have control over the asset. So you know how it's nice that you get to make decisions like, ooh, my Amazon stock is up, I'm going to sell it. Or, ooh, my house is worth 10 times more than when I bought it, which is happening now. Like, I'm going to sell now. Okay, that's awesome. You can do that because it's yours. But when you're a passive investor, you don't get to control that. Okay, this is also another big one. So not all, but many investments are limited to accredited investors only. So accredited investor is someone who makes $200,000 annual income as a single person, or $300,000 as a couple, or they have accumulated $1 million in net worth. So if you're not there yet, like I said, there's still plenty of options, but this may be a good goal to get you there, whether it's on your income or your net worth, because a whole new world will be open to you of things that you can invest in. I know it definitely took me a long time to get there, but I'm there now. So now I can, have access to these investments. So I just want to point that out. I hope that does not discourage anyone. I'll tell you.
I think one of those things is those attainable goals. And so we talked about the minimum of investment of just $10.
Yeah.
Obviously, someone is starting at the $10 mark.
Yep.
And then at some point in time, they become that accredited investor if you're taking the right steps that you need to take in order to either maximize your income. But one, the returns on this could count towards your income. But then on top of that, if you're looking at reducing as much debt, so your net worth actually continues to increase as you accumulate assets too. So it's definitely twofold. Is the best time to get started is now. So that's always one of the bigger things in terms of what should I do if I should. And then not everyone has to be an accredited investor. So I know you were given some resources in terms of which deals you have to be an accredited investor for and which deals you might not.
Yep, exactly. And some of them actually require you to go through a process to get verified as an accredited investor, and some are a little more lax, like they just ask you, are you an accredited investor? I mean, of course you want to be honest, but in things like valuing your house, for example, you may bump up the value a little bit just to get you up to that $1 million net worth. Oh my gosh, don't put this in the video. No, I'm kidding. But the point is that, especially with real estate, you can increase your net worth rather quickly, because values are going up so quickly. So it's definitely something to think about if you want to get into this asset class. So, and then the last thing is, make sure you vet the sponsor thoroughly. I kind of mentioned that. You're trusting these people with your hard-earned money, and so just do your due diligence before investing. I know, people have, talked about losing all their money when they make an investment. And so that's scary, and that's a real fear that I know people have. So The most important thing here is just to vet the sponsors. And I'm going to share the ones that we vetted, that we trust, that we're investing with. But I really just put that out there for everyone to just make sure you do that. It's a really important step. So I'm just going to close with a little bit about why I love multifamily commercial real estate as an asset class. So one that I've mentioned already, it's a hard asset. It's real. You can drive by and go see it, it can be improved, that's part of the business plan oftentimes, is to, bring it up to today's standards. So it's something you can actually work on and make it better and make it more valuable. Two is that I can choose the geographic locations and focus on areas I know well, or places I want to invest. So we've invested a lot in Texas, because that's where we live. We live in Austin, Texas. But I know that, we also have some in our funds. We have a lot of investments in the South and the Southeast. So, if you're like, I really want to invest in this state, but how am I going to do that? Well, here's how, So I can choose the sponsor and invest with people I trust. That's number three. Number four, I think, this is in general, people will always need a place to live. And more people are choosing to rent instead of buy, which may not necessarily be a choice. It may just be that the home prices are unaffordable in their city. I know that's definitely happening in Austin. Unfortunately, even rents are getting unaffordable here. But I feel like, as a commercial real estate investor, I don't have to worry that people are going to stop renting apartments, The great tax advantages, like I mentioned, I love the monthly cash flow, of course. I mean, that's why we do this. And then the possibility of appreciation and a large equity payout in the future. So that's something, we have our little spreadsheet and we figured out, okay, when is each deal going to hopefully sell and that we get to receive our profit. So we've kind of tried to time ours out so that our first year of retirement, this one's going to sell and we're going to get that payout. Second year, a different one's going to sell and that we'll get that payout, and that's kind of partly how we're going to fund our retirement. Okay, number 8, we haven't talked a lot about it, but leverage, right? This is a big one because how am I ever in my wildest dreams going to buy $112 million apartment complex? That is just never going to happen. I'm sorry. I don't mean to say never because you should dream big, right? But I mean, it's probably not going to happen. But I can still be part owner of that apartment complex through leveraging other people and other people's money and other people's expertise, other people's time, managing the project. So I get to invest in some pretty awesome large deals through leveraging other people. So that's a good one. And then number 9, opportunity for diversification. Like I said, we have stocks, we have residential, and this is just another asset class to diversify even more, diversify in geographic location. We have invested so far in one senior living complex, I guess, which by the way, that was before COVID. But it's not a senior home. It's like an active living, active over 55 apartment complex. We've done that, and then we've done apartment complexes, and we've done hotels. So we've kind of diversified within that. And it is passive. Yay! No tenant phone calls. No trading my time for money. My money is working for me. So that's the most beautiful thing out there. So that's why we do it.
Now, Colette, you talked about vetting your sponsors. What are some of the things you're looking for when you're vetting those sponsors?
So definitely meet them or talk to them in person for starters, because I feel like just reading about them online or whatever is just not going to, you're not going to get a sense. So when you're able to talk to them in person or on the phone, find out how long they've been in business, how long have they been doing this, how many deals have they actually done? How large is their company or their fund? Like, for example, Origin is one of the is the equity fund that we're invested in, and they have like $1.4 billion of assets under management. So they're not, your mom and pop, let's just buy 2 apartment complexes a year. I mean, they're really like, this is their business, and this is their expertise, and this is what they have experience in. So finding out how large their assets are, or what they're worth, basically, or how much money they have in their fund, how many investors they have, would be a good question to ask. And how long have they had those investors? Like, make sure they have some long-term investors, because that just shows that they're doing something right if they're keeping people. Some things like where do they invest? So you just want to make sure they're investing in places that you want to invest. One thing that's come up with funds sometimes is the way they're structured can affect how you have to pay taxes on the money received. For example, one fund that we looked into it seemed really great, but they had properties in like 14 different states. And guess what? We were going to have to file a state income tax filing in every single state that they were invested in. So we were like, well, that just seems a little excessive. So that's something you have to find out, is like, are we going to have to file taxes in multiple states? How are we going to receive our distributions? Is it monthly or is it quarterly? It's usually one of those two. And of course, monthly is preferred, right? That's mostly all the ones we've invested in are monthly. And almost they're all electronic, right? They're all just direct deposit, but just to be sure, that'd be something maybe to ask and confirm. What kind of reporting will you receive? So and how often will you receive it? So I want to know what's going on. It's really interesting in the development deals, because they send these quarterly updates, and they'll send like pictures of the apartment getting built, so I got to see it from dirt, and now it's like a whole apartment complex. So those are fun to receive, those updates. And then also, of course, to see how they're doing, as far as the budget and what's there's something called NOI, the net operating income, like how much our distribution is going to be this next quarter or this next month. So just, what kind of transparency do they provide into what they're doing, into how everything's going, and how often do they provide that would be good. And are they accessible? Even if they're providing a bunch of information, are they accessible if you have a question, or you need to talk to them about something? So who's your point of contact? That would probably be good things to ask.
Those are some good questions I probably wouldn't have thought about. Especially when you get a few moments to speak to a sponsor, you want to know what you need to know versus just whatever they're actually going to provide to you. And I think that might be a harder or more intimidating part of the process.
Well, and definitely do the webinars, because they almost all have webinars. Well, they'll answer questions, so you can ask your questions, but then also you get to hear the answers from other people's questions. So like when I first started this, I didn't know what to ask, and so I was just listening to what other people were asking. And then I was like, oh, that's a good question. Oh, it's a good question, So I kind of started to learn, okay, and that still happens where other people ask questions that I hadn't thought of. Like somebody the other day was asking about this property that was kind of close to a highway, and they were asking about what is the road noise, or, is it going to be noisy to the point where people are not going to want to live there? And the sponsor said, well, we've already thought about that, and everything is soundproof. Like, we have soundproof windows and soundproof this and that, and it's all like set up for that. So that was a good question, because I hadn't really looked at the map to see where it was exactly. And even if I had looked at a map, I don't know if I would have realized that is like an interstate highway right there, So yeah, I think it's good to like just be involved as much as you can. You could go to webinars all day, every day, and you don't ever have to invest if you're not ready. You can just be in the learning mode for a long time and just listening to what people are saying. And little by little, you'll start to pick up on things and understand it better. And then once you feel comfortable, you got to take that risk at some point and invest.
Now, are there some deals that you walked away from? So you're listening to that webinar and you're like, okay, that sounds like a red flag, or
Yeah.
I definitely don't think that's going to be a successful project. Are there some of those that you kind of walked away from and said, no, not for me?
Yeah, well, we definitely have walked away from some. So I grew up in Houston, and I love Texas, but Houston is not is to me it's not where all the jobs are going in Texas. It's a lot, oil and gas heavy. And so I feel like, building more and more and more in Houston is, I mean, every city is going to need affordable housing, but I also feel like I wanted to invest more where I feel like the jobs are going, where I feel based on, everything I've learned, where the demographics are shifting. So we kind of walked away from a Houston opportunity for that reason. It was also going to be a 10-year project. So it just seemed it was like multi-phases, and it was like this swimming pool and this swimming pool. It was just so involved in such a long process. And I was like, oh my gosh, 10 years, that's just felt a little too long for me. I don't know. I mean, maybe it's going to turn out to be an amazing investment, but that's one that I can think of off the top of my head that we were just like, no, I'm not going to do that one.
When you think about your journey, are there some mistakes that you can say that you've made that you're like, goodness gracious, I shouldn't have, or maybe a deal that you passed up or should have threw some more money at? Any of those mistakes that you can think of?
I mean, I guess one thing is that I wish I would have started doing this sooner. I just started investing in commercial real estate probably like maybe 3 years ago. And so I think about, just the opportunities that if I had started sooner, I don't know if I would have been able to, honestly, if I would have had, the ability, but if I had, or if I had had that in my radar even, I probably would have started way sooner. So that's one thing. Same with real estate, just with my residential real estate. I bought my first house when I was 30, which is, that's great, and I mean, I don't mean to be hard on myself, but, to just think, oh, if I had started sooner, I would have this much more equity by now. Same with, I didn't start investing in my company 401k when I, had a corporate job. I didn't invest in the 401k for like the first decade, my entire 20s. Honestly, I probably didn't even start until I was about 35. And then I did my own because I was, self-employed as a realtor. So I set up a SEP IRA and started investing in that. And it's, kind of going back to what we were talking about with, the difference between men and women and kind of equality. When I got married, my husband did have a 401k. He had been putting money into that for many years. And so I was like, oh, great. Then we don't have to worry about that. We'll just focus on our real estate and this and that. I'm going to do be a realtor and you do your job. We're good. Well, then I went to talk to our CPA and she said, have you thought about doing a SEP IRA? Because as a self-employed person, you can defer taxes. If you put $10,000 in that a year, that's $10,000 you're not going to be taxed on that year. And I told her, oh, no, I don't need to do that because my husband has a retirement account. And she said, okay, but that's not yours. That's his that he had before you got married. So I really recommend that you get your own, so I did. I started that, but like I said, I was already, well into my 30s. So I think it's probably one of the biggest things that I wish I would have done differently is start sooner.
I think a lot of people are thinking the same thing. Like,
I know.
the
The best time was 10 years ago. The second best time is today.
Yes, you don't know what you don't know. And I think a lot of these topics are just intimidating.
Yeah.
And so as we try and determine what's the best path for us, I know a few people in the group, we have, residential, and we're like, okay, I'm a landlord. And if you've been a landlord over the past few years, you're probably like, goodness gracious, between changes and rules and COVID rules, and some people have tenants that are paying and some people don't. The prospect of passive sounds very nice. And I know I've looked at the purchase and acquisition of commercial property before. And I'm like, my God, like these are some big, those are 2 comma numbers opposed to 1 comma numbers. And this gives you the opportunity to still be in the commercial space without having to come up with 2 commas worth of investment. So I thought this was a really good topic, especially for ladies that are saying, goodness gracious, there's something else that I want to do. Love these books. I'm looking at even some of the podcasts and so forth. And I think that's one of the bigger things is there are so many options out there, so many great resources. And part of it is just, we don't know. We don't know where to start. And so definitely I have put your information. And so you can, of course, reach out directly to Colette. So if you are in Austin, if you're looking for a home, looking for a rental home, whatever that might be, she can definitely help you with that, but also with questions. And so if you have any other questions, we got a couple people said she's very interested in pursuing this path. Very intimidating to think of. So I can definitely understand that these projects get bigger and bigger and you're like, I don't even know what to ask for a 500 apartment complex or hotel. How do you know it's a good hotel or a bad hotel? We know where we want to stay. We know the difference in, 4-star and a 2-star hotel, but not necessarily a 4-star or a 2-star investment hotel. So we have a few people that are thanking you for the information too. And I think it's just key when we talk about what are we investing in and what direction are we going? Are we just doing the basics? And like you said, you were like, got a couple rental houses and that's going well. But to have that true diversification in terms of the different types of investments that you're making, the different time horizons and so forth, I think it was so informative to me. And based on what some of the ladies are saying, they're definitely getting a lot out of it as well. So I want to thank you for bringing this information to us. And Colette, do you have any final remarks for the ladies?
Well, I want to go back to when I first became a realtor. I looked into potentially getting into commercial real estate back then, as a broker. And people told me, yeah, you have to choose. Are you going to go commercial real estate or are you going to go residential? And so I started looking into commercial real estate back then. This is like in 2007. 2007. No, sorry, 2004. And I looked up all these commercial real estate websites and stuff, and guess what I saw? It was all white men. And I thought, oh, this is like a good old boys club, like I can't get into commercial real estate. Like I'm never going to be successful. I don't do what they do. I don't go out and play golf and go to the bars and whatever. I'm not a white man. So I thought, okay, I'm going to go into residential because of that. And because I actually felt intimidated by what I saw, And so now here I am, fast forward, almost 20 years later, and I'm investing in commercial real estate. And I just feel like as women, we just have to focus on, there's nothing to be intimidated about. This is all things that we can learn and we can get involved. And there's no reason why women cannot be doing this. And there's so many reasons why we should be doing it. So I really just encourage everybody, just, take that little bit of risk sometimes, it feels uncomfortable, but it's so worth it in the end. And I am available if anybody has, questions or anything, please, you can come to me directly. I'm happy to help. And I don't know if you send out the presentation, but I want to make sure everybody gets these resources because all the different investments that we've done are on here, and then the books and then podcasts. So, or however you can get it to people, I think, I would like to share it. And of course, my information in case anyone has follow-up questions.
Yes, indeed. So everything, of course, will be on the YouTube channel. And then I also send out a little newsletter for you if you missed part of it. I know depending on the different time zones you're in, some people are like, I haven't got off work yet. And some people, we do have a couple of international participants as well. And I know a few people are like, I am heading to bed, so they're not staying up with us the whole session. So regardless of where you joined, you won't miss any part of the recording today. So you'll actually get that link if you're on our mailing list as well. So I am so thankful. Love the resources. I'm like, okay, I'm gonna check some of these out myself as well. And it's just so key as we're talking about so many things in terms of where the economy is going, where it's been. If you've lived through some portion of the recession, and goodness gracious, everything that we've dealt with in the world of COVID, it's so key to have your hands in a few different things and really make sure that you have a little more comfort, but also just to understand what else is out there. And so Colette has her email address there, her website. Regardless if you're in Texas or not, just reach out to her. I'm sure she'll be a great resource as you kind of navigate your way throughout. And if you have any other questions, we have somebody checking in from LA. So yes, I know you're probably like just locking off from your work. And so we are happy to have you. And so if you're on the East Coast, you're like, goodness gracious, it's like 2 minutes before we start getting ready for bed. But I want to appreciate any and everybody, regardless of what time zone that you're in, for joining us. And as always, I want to make sure that you are taking this information and using it to customize your own financial independence journey. And please remember to join us for our next Money Monday. Until then, have a great night.
Thank you.